Well, let's move on now. The fall of the Indian currency against the US dollar is far from over. Rupee recorded its lowest yet again on opening today at 79.96. The Indian currency is inching towards the 80 mark as global sentiments of a potential recession in the United States also gaining momentum. Meanwhile, the war in Europe and rising inflation also continuing to hurt the Indian currency as well. Let me, in fact, go across to Anisha, who's joining us here from the Mumbai newsroom to give us an update. Anisha, what is happening at this point in time with regard to the rupee? 79.96, but it has pulled back a little bit from that point.
It does look like that RBI is intervening a tad bit because we haven't really touched that 80 mark. We went to the level of 79.96, then suddenly slipped to around 79.89 and continue to meander around that zone. But it's a matter of when rather than if, when we'll hit the mark of 80, because psychologically we're almost there. And as you pointed out, a lot of headlines coming in from the world of currency, not only what's happening with India, but the euro-dollar parity that the globe has been talking about, plus the kind of depreciation that has happened in currencies across the globe. Now, let's first understand the reason of the rupee depreciation. First is that there has been dollar strength. The dollar is sitting at 24-year high level when it comes to the dollar spot index, which is currently at 108.50, and the dollar strength means that rest of the currencies are weakening against it, and that's the reason we have been seeing that phenomenon play out. Separately, we have seen a lot of FII outflows or the fund outflows from India to other countries, and that's the reason we have been caught into this catch-22 situation. Separately, India is an import-heavy country. Given the fact that crude prices are escalated and our trade deficit has widened, that does not augur good news for India either. Now, in terms of how India really stacks up with other currencies, well, we have performed much better than what other currencies have done. If you look at the likes of Turkish lira or Argentinian peso, they are down anywhere between 20 to 24%. And even if you compare it with other developed market currencies, the likes of euro or pound, they have depreciated anywhere between 10 to 12% this year. In comparison to all of that, the Indian currency has depreciated by just 7%, and that tells you that there is quite a bit of strength which is there in this currency, and that's quite visible with the forex reserves as well. Yes, they have come off. We were at that $640 billion mark when it comes to currency reserves, which has fallen below the 600 mark, but still it continues to be quite healthy. Overall, in terms of the impact of this rupee depreciation, well, the impact would be that current account deficit will widen, trade account deficit will widen, which is not really good news coming in for India. However, the good news is that export-facing companies and sectors will stand to gain, the likes of IT, pharma, and the companies which import a lot in dollar terms stand to lose a tad bit. Overall, if you're looking at traveling as well, that might also not work out well given the fact that the currencies have depreciated. But yes, overall, as you said, there are a lot of headlines coming in from the world of currency, and we are watching out for it very closely. 80 very close mark when it comes to rupee versus the greenback. RBI has been doing its bit, but looks like we are headed there.
Absolutely, Anisha. Thank you so much for breaking that down and putting it into perspective for us. But at this point in time, let's also bring in an expert here for more perspective. Nilanjan Banik, who's an economist, joins us on the broadcast. Thank you very much for speaking to us here on Mirror Now. Very close to that 80 level mark, psychological level really as far as the rupee is concerned. But given that we were almost there and then there has been a pullback, clearly it seems that there is some intervention from the RBI, but this is going to happen.
Yeah, so this is not surprising because if you see what is our major imports, these are what we call price inelastic. For instance, crude oil, coal. So these are the things that is needed for a expanding economy like India for meeting our energy requirement. Okay, so we just can't do away with this coal or crude type of import. Even if you see the other important type of imports, for instance, pharmaceutical product, vaccines, these are also essential items. So irrespective of what happens, you will have to import all these items. Now, when it comes to export, you have to understand that unlike import, which is price inelastic, our export is price income elastic, meaning that as the income of the foreign countries grow, our demand for our exports grow. Now, what is happening over the world, you will see that we are heading for a recession, be it in Europe, be it in US. You have high inflation. You also have the job numbers not that exciting. In addition to that, what we find in terms of our export, India is exporting items which are not that qualitatively competitive in comparison to, let's say, some other countries, let's say China, Taiwan, Bangladesh, Vietnam, which happens to be our major competitors. So let me explain. So when we are talking about the pharmaceutical product, a big chunk of it, what we term as intra-industry trade, meaning that we also export, we also import. But if you see the value of our import, it's much higher compared to the value of our export. What it tells you that in terms of the quality, our exportable items are not as competitive as what we see in case of the Chinese import. Although we are exporting and importing the same items, in this case, the pharmaceutical product, but we are incurring a higher trade deficit. So what is the way out? India has actually got competitive advantage in services. Unfortunately, when we are talking about comprehensive economic partnership, be it with South Korea, be it with Japan, in most of the cases, we are failing to bring services to the table. So the way out would be that in India, because we are having competitive advantage in services, why can't we also in the negotiating table tell our trading partners that we will be exporting and importing goods or merchandise items, provided you give market access to our services. And only on that way, I think it is possible to restrict some of the widening budget deficit that we are seeing right now. Otherwise, if you go by the law of one price, which basically tells you what should be the ideal value of rupee, at this point of time, the prediction is the rupee may actually continue to depreciate, and it can go as much high as 84 rupees.
Absolutely. Now, the other aspect, of course, is RBI has been trying to do its bit in trying to stem the loss, but none of that has been working too much. And even the recent big announcement by the RBI for letting settlements happen in the currency, Indian currency instead of the US dollar, that also would have a long-term effect and not do much in the short term, if I'm not wrong.
Yeah, it all comes with a lag, you know. But even if you look into the RBI intervention, when the rupee is depreciating, they actually intervene quite aggressively, as opposed to when rupee is appreciating, you know. Now, in spite of, you know, government of India has also launched various schemes, like for instance, PLI scheme, but in order to strengthen our export. But what is happening is the PLI scheme, if you look into the 13 sectors on which the PLI scheme the government has introduced, you will find that most of these sectors are actually the sectors which actually import the input to produce the final output. For instance, electronic items, you know, or telephone items. So basically, you are trying to give protection to the sectors which are maybe not competitive enough in the world market. So therefore, it is very much needed that you try to focus on the sectors, in this particular case, the services, and also maybe labor, because India has a huge supply of skilled labor, for instance, nursing, which are in big demand in Western countries, even in Japan and South Korea. So if somehow the government can negotiate with this country saying that, hey, we will give you market access for your merchandise items, goods, provided you give access to our services and labor, in this case, skilled laborers, doctors, engineers, nurses, paramedics, workers, you know, so this type of services are huge in demand in Europe and in developed part of Asia. So if that can happen, I think it will be possible to restrain our trade deficit just by intervening in the foreign exchange market. As you have heard, that it has come down from in excess of $640 billion to now almost close to less than $600 billion. I think going forward, just by intervening, it's not going to make sense. Strategically, you have to think that how to bring in other sectors, other areas where India has got competitive advantage and try to negotiate with our trading partner, so that that can actually bring some more additional money to our system.
All right. Thank you very much, Nilanjan Banik, for joining us and putting all of that into perspective.
Thank you very much.